Welcome to Subramani. There is what is called the rodent effect or the cobra effect. I do not even know whether it happened, but it's a nice story to tell. When the British came to India, or they found the rodents and cobra very dangerous to deal with, right? So they didn't know what to do. So they created a scheme saying for killed cobras and killed rodents, we will pay you money. So initially the response was very good, that they got a lot of killed snakes and rodents, and after some time they found that the number of snakes being killed was very high. Then they realized that cobra farms had been set up just for supplying cobras so that people could kill and make money, right? So if you were getting say 5 rupees for a snake and it was costing you 2 rupees to make a snake or create a snake, and snakes you could have in captivity, then it made a lot of sense. It made a lot of business sense. So that was what was happening. Then suddenly the Brits woke up and said, we will no longer give this. So what happened was, all the farms which were set up for supplying cobras just released the cobras out in the wild. They didn't want to kill it, they just let it go. So the unintended consequence of paying money for killed cobra was it actually increased the cobras, right? Why am I saying this? Because we have all been brought up, or many of us have been brought up saying nice things about bonds. When I say bonds, what it means is safety, right? Is my money safe? Yes, your money is safe. Will you get fixed rates of interest? Yes, you will get fixed rates of interest. Can you buy it for 30 years? Yes, you can buy it for 30 years. There is tremendous value in this because it is safe. Ditto for endowment products, right? Ditto for any government scheme. Is your money safe? Yes, your money is safe. So if you put it today in 2023, will you get it back in 2053? Yes, you will get it back. Exactly the way you put it, you will get it back, because it will not adjust to inflation. The interest that you have got may have kept pace with inflation or may not have kept pace with inflation, and that's the return that you will get. Your 100 rupees will come back to you exactly as 100 rupees, which means 100 rupees of 1901 will come back to you in 2025 as 100 rupees, and it makes no sense because inflation would have eroded value. Last few months I've been calculating the capital gains that people are making on selling real estate, and I find that they have no capital gains. But that's not the way they tell you. The way they tell you is, oh, I put 90 lakhs, I got 135 lakhs, I made 45 lakhs profit. Yes, fantastic, 45 lakhs profit on paper, but when you adjust it for indexation, you find there is no tax to be paid, or maybe 1 lakh of taxes to be paid, which means your money has just kept pace with inflation. Similarly, if you invest in bond funds over 7-8 years, the returns were tax free. Why were they tax free? Because of indexation benefits, the tax was very little. I'm not saying it was tax free, it was very, very insignificant amount of tax, which again meant that your bonds just kept pace with inflation. They did not give you any growth, which comes to us to answer one question: will real estate, will bonds, will gold create wealth? Real estate may, provided you know how to buy, when to buy, and how to trade in real estate, in the sense that for Niranjan Hiranandani it has made money, but I do not know of too many people who have made money in dealing with real estate. And that is just on a inflation basis. If you say at that point in time where was the index and where it is now compared to the equity markets, they have not made money. Some people may have made money. It's not to say that nobody has made money. In some areas, some locations, you may have made money in the short run, but however, if you have kept it for the long run, like say 10 years, 12 years, very few people would have made money. All those people who bought, say, in 2003 and rode the boom from 2003 to 2007 may have made some money, but overall people have not made money. I mean, we are in 2023, so I think most people who bought after 2007, 2008, most people wouldn't have made money. When I say made money, I'm saying creating wealth. Creating wealth, you have to get a return higher than inflation. So let's say you bought an asset for X amount, then you have to sell it at a huge big number, especially if it is after say 10 years, so that you make some money after adjusting for inflation. So when I do gold calculations, or when I do real estate calculations, or when I do bond calculations, and I find that there is no tax to be paid, you realize that gold can still give you decent return in terms of rupees, but pathetic return in case of dollar, right? So if you are saying, okay, I need a dollar proof asset, what can it be? Yes, it can be gold. But they don't create wealth, right? So what do you have to do to create wealth? You have no choice but to come to equity, or go to REIT, provided REITs are attractively priced. Currently in India, REITs are not attractively priced. There is no way how you can make too much money out of REITs. Yes, you can say I will put some portion of my money as a risk reduction because I need to remove money from equity. Perfectly all right. So there are people who do that, right? So take all the dividends and buy SGB. Take all the dividends, put it into debt schemes, right? Anyway, all of us put money in PPF and all that kind of thing. So that is anyway a given. Apart from that, do you need debt in your portfolio? Maybe not, especially not with the current taxation regime. However, what you can do is put money in multi-asset funds, so that the fund manager has some liberty. When the equity markets are not doing well, he can increase the stake in debt. When he's not comfortable with equity valuations, or he's not able to find good assets in the debt space, he can go and buy some gold, right? So he has a greater leeway in where to invest, and therefore a multi-asset fund. And on a multi-asset fund, there's one more advantage, that you get taxed at better rates than how you would get taxed in a gold fund or in a debt fund. So therefore, to create wealth in the long run, you need equity, and you need equity to be fairly taxed. Now, a 10% tax hurts, but a 20% tax is worse, right? Actually no, because if inflation were to be even at 7-8%, after 4 years, 5 years, or actually even after 3 years, you will find that debt taxation is better. So look for assets which are ideally, in an ideal world, 4 asset classes completely unrelated to each other, or with zero correlation. However, that is not going to be possible. So you have funds which are saying we will put debt, equity, and real gold. There are some which are saying we'll put debt, Indian equity, debt, foreign equity, and gold. So all kinds of combinations are there. See what suits you, and also understand this is like increasing the strength of that particular portfolio by bringing 3-4 things together, right? It's like creating a metal out of 3-4 other metals. That metal invariably is strong. So yes, you will find less fluctuation. You may find returns closer to equity. Please remember, it has if a fund has 35% in Indian equity and 35% in US equity, and some correlation is established, it is possible that both can go up or go down at the same time, right? So those kind of risks you anyway run in any of these funds. But to create wealth using bonds, or using gold, or even using real estate, for the common man seems to be very difficult, which brings us back to the only asset class which I know and which I deal with, that is equity. Thank you.